Hello, everybody. It's Max Convexity. Happy Wednesday morning. I forgot what day it was for a second. All right. I'm on vacation and I don't have any of my same routine down and everything. But the good news is I got some really nice shout outs this week from some influencers that I really respect. Ethan Gallstad, but also Retire on Dividends and uh, and also Mike, the tactical stock scalper. So the bottom line is, I have a ton of new subscribers. So I wanted to go over a comment that I got and try to answer it because I figured other people might have this question as well. All right, it's down here somewhere. Okay, I got two comments I want to address. The first one says, can you do a video on how you're able to track and calculate these trades from Defiance? I want to learn. And if you already have an Excel with codes and whatnot, I'm interested as well. Okay, so let's talk about where these numbers come from. Or first of all, let's answer the second question first, because I think it'll answer both of them. All right, can you do a video? Okay, so here it is. So this one I also want to, hello, new to your channel, and thanks for subscribing. Would you post a link to a video walking through your trading methodology or setup, how you use options to trade these plays you are taking us through? I'm not entirely clear how you find the entries and how you decide the strikes and deltas to use. For example, when you say they are going for less capture, what does that mean and who are they? And that's a great question. That is a great question. Okay, what I am tracking and who they is fund managers that trade the fund, or that the fund managers that have the fund QQQY. They're from a company named Defiance. Here's what their website looks like. These guys have ETFs. They have three of them that I track. They have more than three ETFs, but there's three of them that I track. One of them's called the QQQY, one of them's called the JEPY, and one of them's called the IWMY. These guys, these fund managers, they sell options inside of the ETFs to make money. And then at the end of the month, they take the money that they made from selling options and they pay it out to shareholders as a dividend. So these funds are brand new, and a bunch of people thought they were scams because they pay so much money, and there's other reasons too that that people thought that. But the main reason is these things can yield 60% a year. And so that strikes a lot of people as being too good to be true. And it isn't too good to be true, and these things are not scams. There are caveats and there are things you have to be careful for and allow for, but they aren't scams. They're good. And I'm an option trader, and so what I'm doing is I'm looking at these option trades the fund managers are making. I'm not suggesting we make any option trades. I'm not really suggesting anything. I'm not a financial planner. I'm just fascinated with these funds because they pay so much. They pay so much dividends. The dividends are so high, and so I'm trying to explain to people how they're able to pay that much of a dividend without being a scam. So every day, what they do is the fund managers sell an option. They sell a put every day, and they sell about a 65 delta put. So here's an option simulation program, and let's see. So this is actually the Defiance trade for the QQQYs loaded up. So the QQQY ETF, I know this is complicated. The QQQY ETF trades puts on the NDX. The NDX is the NASDAQ 100 index. The JEPY, which is a different ETF by the same family, they trade SPX options. So that's S&P 500 options. And then there's IWMY. That's the third fund I'm talking about. And they trade Russell 2000 options to pay these dividends. So going back to QQQY and NDX. I loaded up the trade, the I'm sorry, the QQQY made at the end of the day yesterday. And the reason I know what trade they made at the end of the day yesterday is because you can go to their website and you can look at their website, and their website will show you. You can go down here to intraday trades, and it'll open an Excel file, and it shows you right here. All right, so this is the date over here to the left is the day the options expire. So they had an option. The top line is there was an option that expired on the 19th, and it was a well, I'm sorry, they sold this option on the 19th. It expired on the 21st. See that 23 12 or no, I'm sorry, 23 12 19. Okay, it did expire on the 19th. Anyway, that doesn't really matter. They bought to close that option. And there's no price because that means that option just expired worthless. When you're selling options, you want them to expire worthless. That's how you make a full profit. So anyway, that means the option went to zero. And if you're selling something short, you want it to go to zero. That's the whole plan. So anyway, I have to take that number and I go back to the spreadsheet and I put that in my spreadsheet. You haven't seen the spreadsheet yet. Like I say, I know this is convoluted. My channel was really small, and everyone that followed me was also into these funds and know every intricate detail of them. But now that I've got these shout outs from all these famous influencers, some of these people don't know, have no idea what I'm talking about. So I'm trying to go back to the beginning. So, but they do an option every day. They sell one option every day, and the idea is it expires worthless the next day. So that's the one they sold on the 19th. But then they did another one on the 19th that expires on the, 23, that expires on the 20th. The last two digits before the P is the date. So that one expires on the 20th. P means it's a put, and the other numbers, 16830 is the 00 is the strike. So these guys on this one, they sold 75 options and they got $49.48. But then they did two transactions. This right here is the same date and the same strike. You can just trust me. I've looked at it till late last night. So they also, the same date, same strike, they also sold 80 options. So altogether, they sold 80 plus 75, which is 155. And they got $49.48 for 75 of them, and they got $47.70 for 80 of them. So then I have to go over to the spreadsheet. So here's my spreadsheet. It's a Google Sheets. It's not Excel. I know Excel's better. Maybe I need to switch over, but Google Sheets works all right so far for my needs. So then what I have to do is I have to go over here and I have to figure out an average price, because I don't want that. I don't need that on two lines. I don't need each option on the individual line. I just want to know what their overall position is. So these guys sold 155 puts at the 16,830 level. That was their strike. The reason they chose that strike, somebody asked me, why did they choose that strike? If you look over here at the option simulator program, this has a delta of 56. They generally sell, their puts they sell are generally the deltas between 60 and 65. They sold this yesterday, and I would bet you yesterday when they sold it, the delta was a little bit higher. But right now the delta's 56. A 50 delta option, just to refresh everyone's mind, is an at-the-money option generally. So a 60 delta option is usually one strike or two strikes in the money. Sure enough, the market closed here where this little white triangle is, and this is a couple of strikes in the money. So this is how they always do it. And the reason these trades are such winners, if you look at this trade, this is a profit and loss graph at the end of the day. The dotted line is where the market is right now. So if the market doesn't move at all by the end of the day, which it will, but this is how you tell that this trade has a lot of time decay in it. Right now, the trade is, if they close the trade, it would theoretically be worth $237,000. But watch, if I roll the time forward, you can see that line going up. So this is like at 150 this afternoon. It's almost a max profit, 220. 230, boom. By the end of the day, that's where you'd expect it. So the reason this is so powerful, like I said, the market's not going to go nowhere. But if it does, you make $561,000. That's because when you sell an option, you have a huge advantage. It's a huge positive expectation trade for the seller because you're capturing the time premium. The buyer is paying the time premium. A buyer of an option needs the index to move further than everyone thinks it's going to make money. A seller of an option just needs the index to stay fairly still and they make money. Look at this, even if the market drops a little bit, let's say right now the market closed at 16,812 or something yesterday. Let's say the market drops to, 20 points or something by the end of the day, the NASDAQ does. Well, heck, this option still makes $177,000. Let's say it goes up a few points by the end of the day. Well, then this option makes $847,000. Let's say it goes up further. It still makes $847,000. Let's say it goes down that far, as it just went up. It loses $132,000. So see, there's a huge area in the middle where it's going to make money between anywhere from a small move down, a move nowhere, a small move up, or a large move up. It can move up as far as it wants. It can move up 1,000,000 points, and you're still going to make $847,000. That's why these trades are such a big winner, and they're called income trades because you don't need the market to go anywhere to make money. And the people that do these trades, they do them to generate an income. Warren Buffett sells puts. He's a famous seller of puts. In 2008, he sold something like $8 billion worth of puts. And he also does covered calls, and they're very similar. A covered call is very similar to selling a naked put. All right, so that's what those guys do. So let's go back to the spreadsheet. So all I do in the spreadsheet is I put these numbers in. So they have 155 options. 16,830 is the strike. Well, that's also the max profit. Anytime you're selling an option, your ideal situation would be for the market to go to that short strike and stop right there. So you can look at that. So if you're rooting and watching the market, let's say you have the NDX on your phone, you can look at the NDX all day and you could check, okay, it needs to be at 830 or above. If it's above, you still make the same amount of money, but 830s that would be, or 16,830 would be the optimal close. So the option, you got $48 for the option. You received that much for selling it. I had to average those two prices together and figure it out. But that's going to be $48.56. So you can subtract $48.56 from $16,830 and you come up with this number, $16,781.44. That's your minimum profit, or that's your break-even line. Now we're going to look at this. We're going to look at this another way. We can also look at this on a stock chart. Okay, these are 30-minute bars, and the market's closed right now. But each box represents 1 day's action. They sell these options for 1 day, so these are 30-minute bars. So I made the box as long as the day lasts. So you can see yesterday the last bar of the day was above the box, so that's a max profit. If, let's say, the market would have closed somewhere in the box, that still would have been a profit. Let's say the market would have closed right on the bottom line of the box. That would have been a break even. If the market closes underneath the box, then that's when we start incurring a loss, and we would have to buy the options back for more than we paid for them. That doesn't happen very often. In fact, looking at all these days, it hasn't happened. It didn't happen that day. That was max profit. That was max profit. Hang on, let me turn off this alarm. So that was max profit. That was max profit. That was max profit. It looks like the market just opened today. That bar right there is the first bar of the day. So anyway, right now the market's right about at the bottom line. So if the market closed right now, it would be break even. So, I'm going to monitor this all day, and then I'm going to come back on at noon, and we're going to see where this is at noon, where the chart is at noon, in relation to where the profit boxes are. But the profit box, that's where we're aiming for. We want to get it in there or above, and the profit box ties to those numbers right there. 16,830 is the top line. the profit box is 46, 40, whatever it cost. It's 48 tall. Hang on a second. The profit box is $48.56 tall graphically. Look at this. In other words, it goes from 16,830, then I subtract whatever that number 48 was, and that's how tall the profit box is. So you can tell by how tall the profit box is how much premium the fund managers got. Visually, you can tell. On this day, they got more premium because this profit box is taller than this one. Sure enough, we can go to the spreadsheet and we can see, yeah, they did get more premium. They got $77 yesterday. So, so you can look at it that way. This day, you can say they got more premium. This day right here looks like not very much premium. You know, but anyway, so I wanted to do the profit boxes for the people that are visual, but I have to have something to tie it to, so that's the reason I do the spreadsheet. Originally, my spreadsheet wasn't intended to keep track of the profit and loss. I'm not an accountant, and I am an option trader, and I'm trying to prove to everyone how powerful these option strategies work and that this isn't a scam. And the reason these guys can pay us 60% a month in some months is because they're cleaning up on these options. These options, they're putting the time decay in their own favor. People that buy options pay time decay, and buying options is a long-term losing proposition. Not that some people don't make money sometimes buying options, but it's a long-term losing negative proposition. It's like going to a casino. When you sell options, it's like you own the casino. It's a long-term winning proposition. Now, you don't win every time, and there's people that sell options that have blown up their account, and you know, it's not a guarantee, but it puts the odds severely in your favor. Just like there's casinos that have gone out of business. It doesn't happen very often, but it is a thing. It does happen sometimes. So let's see. I hope that covered it pretty well, and I hope I didn't just confuse the heck out of everybody. Let's look at while we're here. Let's look at the market and see what the market's doing. So I mentioned there's another ETF called JEPY. Well, JEPY trades SPX options. So SPX options, here's the SPX chart. Here's the SPX profit box, and this profit box is tiny. I mean, this one, I don't even know why they sold this option, but I do. They sell options every day, but this profit box is getting really small. Yesterday's was a bigger target. But look how we've been doing in the JEPY. That day was a max profit. That day was a max profit because it closed over the profit box. This day it went into the profit box and almost went under it, like we were going to start losing money. But then by the end of the day, it went to max profit. So this day, it's same thing. It went down to the minimum profit line, turned around, went up, and closed in the middle of the box. So that was a partial profit. They didn't get to keep all the option income. They got to keep looks like about 3/4 of it. This day right here, they started out of the box, and they were out of the box the whole day. That's a max profit. This day right here, they ran straight out of the profit box and finished way above it. That's a max profit. And so far, it's too early to tell here. You can see that bar's open right there, but we're right in the middle of the profit box on the JEPY. And while I got you on the line here, let's check IWMY is the third fund, and these guys trade Russell 2000 options. So I also made profit boxes for the Russell 2000. And I also have a spreadsheet that corresponds with this. I'm not going to show it right now. I'm just trying to give an introduction to how this stuff works. And I hope I haven't confused everybody. But so here's the profit box for the Russell. And you can see this red bar that it just opened. So right now, it looks like the Russell's right on the bottom line. So if the Russell were to close right now, or if it stays at this place, by the end of the day, this would be a break even about. So let's see. Let me make sure that answers everything. Let's look over here. Okay. I'm not entirely clear how you find these entries or decide which strikes and deltas to use. And like I say, the fund managers do that. I'm just reporting on what they do. Let's make sure I got everything in this letter. Okay. So this is GG something, but anyway, I really appreciate this comment because I needed to do this anyway, and this comment spurred me on to do it. let's see, and I think there was another comment right up here. Okay. Can you do a video on how you're able to track and calculate these trades from Defiance? And that's why I was showing you the spreadsheet, or not the spreadsheet. That's why I was showing you the website. The website has, this is Defiance websites. They have their ETFs. They have QQQY, they have JEPY, and they have IWMY. So every day I just open up this spreadsheet, or every night, and then I click on, IWMY if I'm going to look at that one. This is the one that trades Russell 2000 contracts. And then you go down here and you go to intraday trades, and it's the same thing as last time. They show you where they, they show you where they, all their trades. They had to buy it. The top line is they had to buy an option back for $1.35. So they didn't make a max profit. So let's look at that on my spreadsheet real quick. Let me explain to you how that works. All right, so, okay, I don't have the IWMY open. We'll go open here, IWMY, open. Thank you so much for your patience. I obviously don't have a script. And all right, so okay, so see that $1.35 right there? That corresponds to that trade. So let's look back. That was yesterday's trade. They sold 258 puts at the 1995 level. So that's their max profit yesterday. They were aiming for 1995 or above for a price on the Russell is what they're aiming for, 1995 or above. They got $18.60 for that option. So their break even is 1995 minus 1860 would be 1976.40. So I use those two numbers, 1995 and 1976.40, to draw the profit box. Anyway, it went on to the end of the day, and they bought the option back for $1.35. So their profit on the trade was the difference. They sold the options for $18.60 and they bought it back for $1.35. So the difference was their profit. So you take that number and you times it by 258 because that's how many contracts they had, and then you times that by 100 because option prices are in hundreds, and you get this number. You get 445,050. This 479 is what they were going for in total if they could have got the thing to expire worthless. Max profit was 479, but since they had to buy it back, they only captured 445,000. All right, I think that's enough confusion for now. Please give me some feedback. Let me know what I need to go over again. If something was unclear, I'll make another video. I'm so happy that I have new subscribers, and I'm happy that everyone's really interested in these funds. So, but back to the first letter, what am I recommending? I'm not recommending anything, but what I would say is if somebody wanted to trade options and they didn't have a lot of experience, in my opinion, it would be better for them to go out and buy one of these funds. Check with your financial planner. It depends on your situation. There's a jillion factors, but if you wanted, some income, you wanted to get income from trading options, but you didn't want to have the headache of trading options, you could buy this fund. They do it for you, and they pay you a dividend every month. Speaking of dividends, just one more thing I forgot to mention. Up here at the top, these are some numbers that are derived from all this money they've earned and all the money they've spent. But this shows you right now what I think the potential dividend might be, and it's going to, and I annualize it to make it an annual number. They aren't going to pay 126% this month, but they might pay 10% because 10 times 12 is, 120. So, and this is based, these guys on the IWMY have been having a really good month. And there's still a few more days, but I'm saying if they, this dividend should be around 10%, maybe 9, maybe 11, but this dividend's going to be pretty hefty this month, in my opinion. So we can look over here at the other spreadsheets. QQQY, they trade the NDX options, of course. That's the first one we talked about. They aren't doing as well. Their dividend, is going to be give or take around 70% a year. So you would divide that by 12, and that's like 5.5% or something, 5.25 or something. So anyway, right before the night before they actually announce the dividend, I'm going to make a video where I'm going to go through all these numbers and try to make a more exact prediction. And instead of just saying, hey, it's going to be somewhere around here, I'll try to actually nail it down, and we'll look at some of this stuff. All right. Well, hopefully that answers a lot of questions. And like I say, please leave me a comment, and we'll go from there. Thank you so much. You guys have a great day.